Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me to discuss trends in the U.S. equity markets and review a couple of option strategies to trade those trends is Tony Zhang, chief options strategist with OptionsPlay. And Tony, of course, the question is, how much longer can this rally be extended in the backdrop of the Fed announcing a new approach to inflation that could keep rates lower for longer?
Yeah, so that's the primary question. I think, when we look at the equity markets, whether we look at the Nasdaq 100 or the SPY, we're starting to see some of the same themes that we've been talking about for what seems like weeks, but actually months now, where we're seeing these negative divergences, which shows us these warning signs that these equity markets are starting to get exhausted. But really what has started to materialize over the last week, actually, is really a strong deterioration of the equity markets. So if we look at the Nasdaq 100 and the SPY, we're seeing negative divergence on the weekly chart. But if we look at the moving averages, the actual components of these stocks, the number of stocks that are now trading below its 20-day, 50-day, and 200-day moving average continues to decline as these markets climb to new all-time highs. These are really big concerns that we have, and that we've seen a significant deterioration here over the last week. This is exactly what we saw back in February, right before the coronavirus sell-off. So the thing I do want to point out here is that when you see these types of negative divergences and moving averages start to move below, a significant portion of the stocks moving below their moving averages, that in itself is not a good reason to short the markets. It's simply just a warning sign. We still need a catalyst to actually move these markets lower. Is the Fed going to be that catalyst? It's possible. I'm not 100% sure that that's going to be the case. So it's extremely important to decouple the two from each other, that these warning signs are not reasons to short the markets. If we look at the advanced decline line of the S&P 500, it also has declined as the markets continue to move higher. So there are growing signs that things are not looking okay and markets are getting exhausted, especially if we look at the VXN, which is the Nasdaq 100 volatility index. So as the markets made a new all-time high, the volatility index actually increased. This is a warning sign, again, that investors are getting nervous about these markets reaching these all-time highs, and there's more put activity, more investors buying put options on the Nasdaq 100 index, perhaps trying to hedge some downside risks. And we've seen Treasury yields also pick up here, despite the Fed language here today. We saw 10-year rates at relative highs here, above 70 basis points. These are some of the concerns that we have here in the markets, and these are all new warning signs that didn't exist just a couple of weeks ago, even though we've been saying the same thing about these negative divergences and signs of exhaustion over the past couple of months.
Tony, how are COVID-19 trends impacting mobility and employment data?
Yeah, so this is really where, when we look at the economic data, we see a pretty mixed bag. And COVID-19 trends, obviously something still very important because we still have over 40,000 cases a day, but this has been trending down significantly over the last few weeks, both daily new cases, positive case ratios, number of deaths and hospitalizations, this continues to decline. So this is a positive, and we need to see these continue in order to see mobility and employment data improve. But when we look at the high frequency mobility data, this is using Google Mobility Trends, we've seen that it pretty much has stalled since the beginning of June. And we're looking to see if we're going to get an uptick here in the next couple of weeks, because we really need to start seeing that in addition with employment starting to improve in order to see more of a V-shaped recovery, because the markets, the equity markets, are currently pricing in a V-shaped recovery, but the economic indicators so far are not pointing in that particular direction. Employment, we've actually seen an uptick in terms of unemployment claims. This is a concern, especially as small businesses are not hiring at the same rate that they were going before. And the only bright spot that we currently see in the economic indicators is really housing. We've seen housing starts come out at multi-year highs. We look at single-family home sales at also multi-decade highs. So this is one of the bright spots in the market, and this is actually showing us a shift in consumer spending. So given the fact that consumer spending drives a large percentage of the US GDP, and we have a move away from travel and entertainment, we've seen a significant uptick in spending on home improvement as we all work from home. Bank of America recently did a survey where prior to COVID-19, only 5% of respondents said that they predominantly work from home. Currently, that level sits at 45%. So you're looking at a 900% increase. So we're going to continue to see the shift in consumer spending towards housing. And that's really one of the ideas that I want to present here today.
All right, and before we get into that idea, let's get into the trade, a bullish one in the financial sector, of course, not a traditional bank, but Morgan Stanley.
Yeah, so I wanted to take a look at the financials as a whole because we've seen the uptick in rates, we've seen a steepening in the curve. This is generally speaking a tailwind for the financials. And out of the major banks, we usually consider JPM as the best of breed, but we really have seen more strength out of Morgan Stanley. It's surprised us here over the last couple of quarters. So I wanted to look at Morgan Stanley because it's just about to break out from this $53 triple top that we've seen Morgan Stanley form this technical formation on. And I think that, in this particular market environment, the primary view here is, number one, not trying to find trades that I want to chase, meaning tech stocks, discretionary stocks at all-time highs. I want to try to find stocks that are rotating from weaker sectors like financials. And more importantly, because of the warning signs that I showed you earlier, I want to make sure that I take the least amount of risk possible. So if the markets do sell off, I'm only risking a small percentage of my portfolio per trade. So on this trade with Morgan Stanley, I'm going out to October. I'm looking for a breakout above this $53 level, and I'm going to use a 57.5 call spread here. Now, I will say that we posted this trade here earlier this morning. Morgan Stanley has moved quite a bit higher since then. So you could potentially adjust this to the 52.5, 57.5 call vertical here. And you're only going to be risking here about a little over 3% of the underlying stock price to take a bullish view if Morgan Stanley breaking out here higher. And if this doesn't work out, you're only risking about 3% of your of the stock's value in order to take this bullish bet.
All right, and of course, if you're getting this on the replay, we're talking at Thursday, August 27th. So if you see any price fluctuations there, but Tony, let's get into the trade with the consumer space. Of course, Home Depot, which is certainly has capitalized on the COVID-19 trends with people staying at home and having to reconfigure to include multiple offices or perhaps build some space outside for remote classroom work. I mean, it's been the perfect environment for it.
Yeah, absolutely. Not only more and more people buying their first homes because of working from home predominantly and people moving out of the cities into the suburbs, but also, as you said, working from home. This is a trend that we do not think is a temporary trend. We think that this is more of a permanent shift, and it's a seismic shift, in my opinion, in terms of consumer spending away from travel and entertainment, which have not seen any uptick at all, versus now in home improvement that has remained resilient. So while Home Depot just reported Q2 earnings that were extremely strong, we expect Q3 and the second half of this year to be fairly resilient on this front. And Home Depot, by far the largest player, not only by do-it-yourself home improvement investors as well as professionals. So Home Depot, I think, is the play here. And same thing, I'm using the same type of trade structure, buying a call debit spread here. I'm going out to October, buying the 290, 320 call spread here, paying about $9.34 per share on a $291 stock. Here, I'm risking less than 4% of the underlying stock's price in order to take this bullish bet. It's an expensive stock, so you have to spend quite a bit of money to play this. Here's a cheaper way to potentially play for upside while limiting your losses to just 4% of the stock price.
All right, Tony, finally, how can the Trade Talks audience learn more about OptionsPlay?
Yeah, so the tool that I just showed you with where I found these strategies and analyze these strategies is OptionsPlay. So we have a free 30-day trial that you can sign up for, which gives you access to daily trading signals here for both entry and exit, gives you access to market outlook sessions and education sessions. This is a free 30-day trial, and you can sign up at trade.optionsplay.com/trade talks.
All right, awesome, Tony. Great stuff as always. Thanks for joining us on Trade Talks.
Thank you so much for having me.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.